Conventional loans, you need to remember these are not insured or guaranteed by the government. Conventional loans may require private mortgage insurance for loan-to-values higher than 80%. FHA insured loans. Remember that FHA itself is not a lender. FHA is an insurance company that insures lenders against losses due to foreclosures. So with an FHA loan, the loan actually comes from a lender and FHA provides the insurance. With FHA loans, there is never a prepayment penalty, and FHA loans are fully assumable by qualified buyers. The VA does not make loans, they guarantee loans. The VA guarantees lenders against losses due to foreclosure. The VA does not lend money, approved lenders lend money. The VA charges a funding fee on each loan to finance their guarantee. The VA guarantees loans, FHA insures loans, and lenders lend money. With a VA loan, HUD qualifies the lenders to participate in the VA program. The appraisers must be VA certified. A VA appraisal is called a certificate of reasonable value that will be on your test. A VA's version of an appraisal is called a certificate of reasonable value. With VA loans, borrowers must meet eligibility requirements set by the VA. Eligibility requirements are available to qualified veterans. Parents of veterans are not eligible. With a VA loan, up to 100% LTV is allowed. Veterans do not have to pay down payments if they don't want to. With a VA loan, there is never a prepayment penalty. Non-veterans who qualify may assume a VA loan. VA loans are always assumable, and it doesn't have to be a veteran assuming the VA loan. Non-veterans can assume a VA loan if they qualify. Agricultural loans are administered by the Farm Service Agency, U.S. Department of Agriculture. The Farm Service Agency provides programs to assist families with purchasing and improving single-family homes in rural areas. Amortized loans. Each payment in an amortized loan partially pays interest as well as a portion of the principal. With an adjustable rate loan or adjustable rate mortgage, ARM, the interest rate is tied to a specific economic indicator and can fluctuate up or down depending on how the indicator fluctuates. We take the indicator plus the lender's margin, and that's the borrower's interest rate. So in an adjustable loan, the interest rate is tied to a specific economic indicator, and the interest rate can fluctuate. And what we do to determine the interest rate is we take the indicator, whatever the indicator says, plus the lender's margin, and that's the borrower's interest rate. For example, a 3% indicator plus a 2% margin equals a 5% borrower's interest rate. ARMs, or adjustable rate mortgages, often include interest and or payment caps, which helps limit how much the interest rate can change. Bridge loans are a type of short-term loan to cover the period, bridge the gap, between the end of one loan and the beginning of another loan. Thus, the word bridge loan, it bridges the gap between the end of one loan and the beginning of another loan. Reverse mortgages. In this arrangement, the mortgagee or lender makes payments to the mortgagor, the borrower. That sounds funny, but that's the way it works. With a reverse mortgage, the mortgagee makes payments to the mortgagor. Reversed mortgages are used by seniors to obtain money from their equity in the property when they don't want to sell, but they want or need cash. With a subprime loan, the borrower pays a higher rate of interest because they fall below prime standards. Owner financing. Another word for owner financing would be contract for deed, land contract, or installment land contract. With an owner financing arrangement, a buyer, a vendee, and a seller, a vendor, agree to the buyer making a down payment and then monthly payments directly to the vendor. The seller or vendor retains title during the whole term of the loan and holds the deed until the loan is paid off or until the loan contract is fulfilled. The buyer, the vendee, receives equitable title only and the right of possession, but not actual title. The buyer pays all the property expenses, including taxes, insurance, and maintenance, and so on. And the seller then transfers legal title to the buyer with a deed when the buyer makes the final payment. Owner financing may occur with residential or commercial transactions, but it's more common with unimproved acreage and farmland sales because it's harder to get loans, traditional loans, on unimproved acreage and farmland sales.